So you might have a goal to get into your own home this year, but you just don't have enough of a deposit. Now, with inflation being at its highest in the last decade, it's only getting harder and harder to save up for that deposit. However, if your parents happen to own their own property for a while and they have some equity in it, you might just be able to buy that property a lot sooner. What's going on, everybody? It's Blandon here again from Mortgage HQ, and in this video, I'm going to share with you how you can buy a property using your parents' equity. I'm going to show you exactly how it works, two of the main methods, the pros and the cons, and how you can get started today. So firstly, how does it work? I'm gonna just chuck on my iPad here. So your parents might have a property like this, and they might have a mortgage, and obviously over time they have paid down this mortgage, and the value of the property has gone up. Now, assuming that they're still working, they can actually go back to the bank and ask for a bit more money. This is called a top-up. So what a top-up allows you to do is usually take that money to use it for things like renovations, or gift a deposit to the kids, or you can buy a new car, or just do something that you need for your family, or perhaps go on a trip. So a top-up, you can use it for many things, and one of the most popular one is to help your kids. So you can top up for a deposit, say for example $150,000. And this is assuming the parents are not in a worse off financial position than they started with when they bought the property. So method number one, so after the parents get this $150,000, they can actually just gift it to their kids. And what they would do is sign a one-page form and show the bank that they don't require any interest and they don't expect it for it to be repaid. So then the kids can literally use this deposit as their own money, and they would be able to just go buy a home. Now, if you do want to arrange for this portion to be repaid and have an interest portion of it, and you want to do it formally with a legal document, that is still not a problem, but the bank will take this into consideration as part of the borrowing capacity for the kids. That means they won't be able to borrow as much money. So some of the disadvantage with this method here, the parents are not going to have as much control over this portion of the money because they have effectively gifted to the kids. Or if they have a formal document to say that they're going to repay this, then the kids are not going to be able to borrow as much. The advantage with this method here of a gifted deposit is that the applications are relatively easy. You've got a top-up for the parents, and then you just got a normal pre-approval loan for the kids. So the approval process is relatively simple. Secondly, if the kids ever default on their repayments or they bankrupt, then the parents only stand to lose this portion of the money, which they know it's a limited amount, which is a good thing because there's no cross guarantee with this portion of money with their current property. So now let's look at the method number two. So the parents would actually put up their house, but what happens is they don't actually borrow money off their own property. They will go buy another property and the bank will fund 100% finance on this particular property. And so with this method here, there's a cross guarantee. So this property is actually tied against that, and this one is tied against that. So what it means is that there are going to be 4 people on the title, and there are going to be 4 borrowers. Now the disadvantage with this method is that there is a cross guarantee, meaning the parents and the kids are 100% liable for all of the debts that you can see on the screen, which is the red and the green. The securities are also up for grabs as well. Say for example, if the kids ever default on this and the parents actually can't afford to pay for this mortgage, then this security is going to be at risk as well. I mean, the chance of that happening is probably very slim, but that is the risk. So how do you actually get started? It's actually pretty easy. I would suggest getting a borrowing assessment first for both parties. That's for the parents and one for the kids. And you can start talking to a mortgage broker like Mortgage HQ. It's actually something that we do for free for our clients. You can just submit your information online and our team will actually send a summary that shows your borrowing capacity and how much your deposit is going to allow you to buy. The advisors will work with you to see which method is going to be best for you, whether you want to go for method 1 or method 2, and then understanding the risk for your position. And if the proposal that we show you is something that will achieve what you want, then we will arrange the mortgage application for you as well. And that's a free service because it's paid by the banks. And your advisor will be able to negotiate the best rates as well. If that's a method that you want to try, you can go to mhu.co.nz, try a mortgage snapshot, or if you just want to email us, support@mhu.co.nz, that works as well. And hopefully you have found that helpful. If you did, please do us a favor, smash the like button for the YouTube algorithm. And I wish you good luck on your house hunting, and I'll see you guys in the next video.